Almost every single investor and trader out there is ignoring this particular stat, ERP. Hello, ladies and gentlemen, and welcome back to the Daily Show where we talk about stocks, commodities, and cryptos. We're less than 24 hours away now from the CPI inflation numbers coming out of the US. We know that's going to be a blockbuster, hugely volatile event. On top of this, we have earnings from the banks coming out later on this week that we need to discuss, but we also need to talk about what's happened recently when it comes to equity risk premium. It's now less than 2% buffer, and this is when we need to put the brakes on and start to assess markets a little bit differently. Well, welcome back everybody to the Daily Show where we talk about the markets around the world. If it's your first time here, welcome. Consider subscribing. We've got some amazing content coming your way. Also, smash that like button if you do find value in today's video. So let's get started by talking about the incredible number of shorts that are starting to appear from bigger players on the US stock market. It's swelling to the highest level we've seen since 2011, and history usually has shown that that's actually technically a good thing for markets. It often means that so many people are bearish, markets can't get through. Now, for anyone that's been watching this channel for a while, you'd be well aware of this being the phenomenon realistically of the last 6 to 9 months. Everyone's bet heavily to the bearish side. This may be the most anticipated or well talked about recession in history, and often that means that things are not as bad. But we still need to face some facts. The Federal Reserve, which is the Fed of course, is there to support markets. They are still tapering, and this CPI number is going to have great impacts into the markets. Have they done the job yet, or do they have to continue to raise and taper? 25 basis points is the expectation now for May. And we can see that there's a lot of neutrality coming into this market. Take a look here at smart money versus dumb money inflow charts. We've seen dumb money kind of pick up this last little bit of steam and smart money sell into that rally. Now we find ourselves at an incredibly critical point. That 41 kind of 10 to 41.50 zone on the S&P 500 is a critical level where if markets breach and break through, we could be looking at 4,300 plus coming up in only a few days. On the flip side, if inflation is not slowed, which we'll talk about soon, then we could be seeing some serious declines in these markets. And that's what it all comes down to. What does this number show and how will the market react? We'll talk about some of our key thought processes on some of the scenarios that might occur after the news event comes out, depending on the tolerance. Let's discuss equity risk premium though. So Mike Wilson of Morgan Stanley has mentioned this several times. I brought it up almost every day on this channel for a month, and there's a reason why. It tends to materially increase during recessionary periods, but it also tends to come down into recession. So what happens is we get this decline, which is kind of like the calm before the storm. So what is equity risk premium? Well, it's the difference between returns on equities or individual stocks and the risk-free rate of return. So are we going to be making more money from being in what we consider risk-free rate returns? Things like government bonds, long-term government bonds also considered. And that's assuming, of course, zero default risk by the government. So if we consider the US government and we say long-term bonds, probably very low chance of default, then how much can we get over there in that money market versus the S&P 500? And this is what every large investor thinks about. Sharpe ratio is another thing that we always consider. And every single time I've ever spoken to any large player in the game, they always talk about these numbers. It's very important to consider that. So back in 2020, during the pandemic lows, we saw earnings yield on the S&P 500 was 6% higher than the 10-year treasuries rate. Now it's less than 2%. That is not much cushion. In fact, the lower this goes, the worse stocks get as an attractive bet. In fact, they almost go to neutral. So let me show you that when we look at some stats here. When we're above 1.7, it's a great time to have stocks. And we've actually been above 1.7 for quite some time, but we've seen some big switches in ERP over those periods. When we tend to get these huge increases, it's a great time to own stocks. And of course, we've had those through some amazing runs. 2010 all the way to 2019 was phenomenal. And we know where we've been since the pandemic as well. We had that huge increase spike. that gave us a excellent entry that then ran through that next 12 to 18 months. So what are we seeing right now? Well, it's coming below the 1.7. This only happens, of course, a third of the time pretty much on markets, but it leads to lackluster returns on S&P 500. And I think that's really important. A lot of people are discussing the idea of a lost decade. Now, a lost decade is effectively where you get minimal or very low returns for quite a period of time. We actually saw this after the tech bust in the US around 2000, 2003, and then we saw very low returns from that period on. Now, of course, it recovered back to the highs, but there wasn't any extra growth on top of that. We also got a lost decade in Europe after the global financial crisis in 2008, 2009, which led to basically neutralized returns. It just recovered back to the highs. So this is one of the factors that I think is very important. We are either going into a low period of annualized returns, and it's not going to be as attractive to be in stocks compared to some bonds. Bonds are the best I've ever seen them since I got into the industry back in 2007, 2008. And, we also are seeing a huge decline here, which is consistent with some other noticeable information we've got from Morgan Stanley's Mike Wilson. Let's take a look at that in a second here. So the S&P 500 after a new low in ERPs, the first time in over a year. We've had reports on this before. It happened back over here. Basically, I think it was in January, February of 2022. Of course, the markets did decline from that point. It's not a super positive market over the next couple of years. 63% of the time, we're positive over a 3-year stint. Now, this is interesting when we take a look at how long we've been in what you would, I guess, say an inverted market in terms of bond yields, because you'll see why this could mean that we need to be fast. And actually, it might be the best time ever for a long time to be a trader in markets more than a long-term hold investor, which has been basically the best for the last decade. So a month later, only 57% of the time are we positive. Interesting, because that's actually not anywhere higher than normal statistics. Normal statistics are about 68% bullish to even 70% bullish over that period. Let's take a look at Mike Wilson's research now. Whenever we've seen the word recession actually come true, we've seen an incredible rise in ERP, and that's led to, of course, an instant decline on stocks, basically a compression there in the stock market in comparison to the risk-free rate, which is the bonds. And we've had this happen every single time in the last. Now, a few people have already mentioned on Twitter to me, yeah, but Tom, the Fed is the buyer of last resort. The Fed ruined the market. Don't worry, zero ERP is a thing now. Well, I'm not too sure about that. I'm not convinced that that's the way it is. The Federal Reserve is there for many things. And yes, they've just put a bazooka in the markets recently, which has led to this increase. But there are significant sicknesses in this market. And I think ERP cannot be understated when you start looking at this. Let's talk about just quickly here some inflation numbers coming into, of course, the inflation report. These are some of the previous ones that have been taken, the forecast rate and then the actual rate. And what you'll notice is if we get over the forecast rate by basically around 0.2, it tends to lead into a negative day for the market. So that's a good way to instantly read it. And if we come in flat, we've actually been going kind of bullish for that session. You can see here, flat to down has been bullish. Well, that's the way it usually would work, I guess. And if we go up maybe 0.2, so let's say this came in at 5.4, theoretically, you would probably end up seeing a bearish day. So yeah, the tolerances are very important. If you get a 5.7 or a 5.6, I don't think the market's going to like that. Technically, the S&P 500 reaction should be negative. If it goes positive first, and then you see it take like a stop loss hunt or something else we'll talk about in one of the scenarios, and then it rejects, that's going to be that patience, react, don't predict we talk about. So yeah, some interesting stats here. And obviously you can see that the actual number and the forecast number are going to be very important. If it comes underneath 5.2 and we go like a 5 or a 4.9, you might even see markets rally through and breach these important zones like 4180 on the S&P. If that occurs, wow, it's going to be a big deal. Let's talk about some other things that are going into this event. And I want to just bring up this chart here again, which is leveraged money is now sitting at a short level that is similar to the August highs. So clearly there is a lot of big money betting on the market going negative. Now, it actually did go negative over that period. So it doesn't mean just because there's a ton of shorts that the markets over the medium term or the short term won't go negative first. And that's where they unwound those negative bets. and then they put them back on recently ahead of this inflation number, ahead of the May Federal Reserve report. So remember we talked about the idea of length of recession. In 2000, we basically busted in the US, and what happened was the markets came back because there were so many businesses that didn't make any money, that didn't make fundamental sense. We all know what happened. It's interesting though when we consider the length of inversion from the start when we're talking about US 2-year versus US 10-year. I think we're on month 13 now of the inversion, and generally the longer the inversion actually lasts, the longer the recession length occurs. And this may be important when we're considering ERP and those lower than standard returns from the S&P in comparison to bonds. I think we'll be doing a lot more bond research here on the channel over the next kind of 3 to 6 months. I've never really had to do it so much in my career. Obviously, the last 12 months, yes, I've done a lot of more bonds because they were just never good. They were just trash for over a decade. Really, they were. There were only one that was any good, in my opinion, which is called hybrids, and they were an Australian-only product. So yeah, most bonds were very, very bad for a very, very long time, and there were only certain periods you want to own them. Now it's become way more attractive than it ever has been, and you can see that through ERP. Let's have a look at sentiment as well. We know that sentiment leading into this CPI number, we'll have a new read on this at the end of the week. I'm very interested to see that. Has turned basically more towards the neutral stance or the bullish stance. This is a big switch. Every time we've seen this over the last literally 18 months, it's meant that the market was starting to top out. If we continue to get more bullish stance, let's say this goes up to something like 40%, which would be an extremely bullish read, I would say once we hit technical resistance, markets should come down. What about the big money managers? They are completely neutral. I consider 400 to 600 the number here, which I'll update on as much as we can, to be a neutralized market. They've put in some money, but they're not all in at this stage. And I think if they have to go all in, you'll see a swelling into the stock market, and we'll have to be on top of that because you can't consider that even though you might have a negative tinge bias, that you are always correct. Being bearish is difficult in markets, very difficult. Let's look at some of the stats behind why you'd be bearish. I'll gloss over this. Watch one of our previous videos. I've talked about it many times. We usually see the curve steepening. Well, we've had that for quite some time. Then we see credit tightening. Silicon Valley Bank, Credit Suisse. Then we tend to get a Fed cut a little bit after that, usually around 3 months. Well, we still might have one more hike and then maybe a stance and then maybe a cut. Remember, the market expects something totally different. They want cuts in like 3-4 months from the Fed. And then we tend to have a broken system that goes down. So I think then we get these EPS troughs, etc. So we need to consider that this is what generally has happened during periods in time like this. Fed pivots are not done out of the goodness of their hearts, and they usually have a nice increase coming into the pivot, which is exactly what's happening in the stock market right now. Whenever the Fed's done these huge spikings, though, of interest rates, they break the system and they usually have to fix it. And of course, we have now a whole bunch of charts that we can show you about this. Here is the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms. More importantly here, commercial, okay? Commercial properties, my goodness. That's going to be another concern here coming up over the next 3 to 6 months. So we've got here 1990s, 2000s, 2008, 2020. Take a look where we are now. Now I'm going to gloss every other one of these because they all show the same thing. Retail sales generally goes negative. We get a recession. US ISM manufacturing PMI generally goes underneath 45. We get a recession. And of course, we know that the market is not following this right now. The market's basically here and saying, we don't see a recession. Everything's all good. But at the same time, does ERP even make sense if you're not being fast, nimble, using multi-month strategies, but maybe, pushing back a little bit on the investment? You do whatever you want to do, but I'm just saying this is an interesting fact. So usually if we have a recession and the bond market is correct in this case, we make a new low at some point over the next 6 to 12 months. That would be kind of consistent. And we usually see also S&P 500 forward earnings compress. Now, there's been some good points. I mean, if you look here, there was a point last year where you could have got just above 15 almost twice here in the S&P. That's a great level. That's a fantastic level when it comes to forward PE and purchasing. And we've had cheaper than that during some of the other pullbacks. So you've got to keep in mind maybe having 6 to 7 separate reasons for why you would want to be in the markets. But I think having hard, fast rules to make decisions when things dip is very important. You're never going to get the exact low, but at least then you have a plan, and having a plan is really key. So why are a lot of people bullish right now? Well, a lot of it's got to do with April being historically the best month of the year. So that's obviously a big point here. We've talked about this tightening kind of thing going on, so we'll move over to that. But that's one of the main reasons that I think a lot of people are bullish. And it's to do with rotation, and also the Fed's balance sheet increase the other day, which I think is a bit misunderstood, leading people to believe that markets are just going to keep going and going and going, kind of similar to the 1920s, 1930s situation. So stock volatility versus bonds, as we know, the VIX has almost no volatility in it, sitting around those 20s. And the bonds market is saying, wait a second, we're still freaking out a little bit here. When we get these readings, we tend to have kangaroo-style market, sideways, or even watershed-style moments that have occurred back in the previous recessionary periods. Here's the kangaroo of 15, 16. So it's not really conclusive, but it says, wait, maybe we need to be a little bit more careful, especially into earnings numbers. Speaking of earnings, we know forward EPS growth turned negative recently, which I think is very important. And we're about to see it at the end of this week. So volatility is not only here in the inflation number, which is CPI number, coming out before the market opened in less than 24 hours, but we've also got Wells Fargo, JP Morgan, along with BlackRock and many others about to tell us what their opinions are on forward earnings and the environment. I think this is going to be very volatile earnings season, at least at the start. And some big stocks such as Microsoft and Apple are already starting to give up some of their gains. Is that an insight into what's going on? Let's take a look at the last 24 hours. Notice that technology and communications, some of the best performing sectors, are down both across the board into the inflation number. And we saw things like energy, financials, things that have been beaten down recently coming up. All of the defensives sitting in the middle. 5 days of rotation. How does that look? Again, defensives out and above. And because we're at a critical level, historically, this is kind of stacking the odds more towards the bear's favor. When you've got utilities, you've got healthcare, you've got staples being some of the best main sectors, it usually means they're turning a little bit more neutral to even defensive, leading into a pretty scary number, which is the inflation report. US 10-year versus 2-year, what have we got going on there? I'm just going to bring this chart up. Remember, we never see a recession until usually this goes back above this 1% and starts to actually steepen up. We don't tend to actually have it when we're heavily inverted. And I think that's very important. A lot of people overlook that. I'm just going to mention it here today. High yield junk bonds. Now, these are not the quality bonds. These are the crappy bonds. How do they look? Well, they had a little bullish session. The market was flat. So again, if this is running with the market, usually that's a good sign. If this is going down and the market's going up, not such a good sign. So we'll be watching high yields, but nothing here at this time. I will bring up treasuries just quickly. A few people have asked me about them. Treasuries are waiting for yields to certainly switch. US 10-year will have to break down below 3.32. And they've had a good little resurgence actually over the last week. So I've seen a bit more money going into treasuries. Remember, people only really want treasuries during 2 times: when they need them, or they perceive they need them, or when everybody hates them. And right now, people are starting to perceive they need them in portfolios, probably because of ERP. If I'm looking at a portfolio of $1 billion, I'd be seriously considering, is it worth the risk of being in the markets in comparison to some risk-free rate investments out there? It's a very interesting concept. If we take a look at copper, we know that copper, or Dr. Copper, runs kind of the world in terms of health. It's right at the same level that we expect it to be at. Previous support becomes resistance. We'll have to find out whether it breaches high or breaches low. We've got cuts. We'll talk about that in the next 24 hours. Dollar index sits at the critical level we discussed in the previous video, and we know it's just kind of sitting here. Previous demand is being purchased, and it's come off those series of highs and through. I think the last 24 hours has probably been all about gold. Gold had an amazing little return. I'm really happy with this level. I thought it was a fantastic zone. I was super happy they bought off there. Love that kind of pullback. Would have wanted it a little bit deeper. If it gotten to 1991 or 1990, that would have been a beautiful buy for the session. I would have given that some ticks of approval, but it went a little bit earlier. What's the price it came down to? Around 1995. And yeah, I mean, basically the market's back to a critical level of turnaround. You can see I'm on the daily level. I'm also on a fib of the whole pullback. So, this is probably a 75 fib. Let's just quickly chuck a quick fib down here. Yeah, so we're sitting about 75 fib, which is considered one of those kind of crit levels. And I expect us to kind of hover here before CPI inflation. If we breach and close a daily above and yields, remember, if interest rates get blasted through 3.32 and they keep going down, then you're probably going to see gold perform fairly well, at least temporarily through that. The trend is still up. If interest rates start going up after the CPI number and they hold up, I wouldn't like gold at this stage. It's a yield play at this point. Let's move over to natural gas. Really like this in the last 24 hours. It did a good session on it, so it had an okay session. You can see down here, the Widowmaker is a nasty one. It moves a lot of percentage. You can see kind of it went up about 2%. I still like this. I think it's kind of bottomed a little bit here, and it's found a critical level. And I like some of the things that we've seen. So yeah, I guess I'm kind of hoping that natural gas continues its way up here in this big exchange. Do remember, natural gas is incredibly dangerous. 30% on daily, moves is nothing for that. It's called the Widowmaker for a reason. Contango's a thing. There's so much risks. Make sure you do your diligence on that one. Let's move over to US oil. What's going on here? Well, we're at supply. A lot of people are saying it should short. We don't have the evidence either way at this stage. If you go to the 2-hour, you would say, well, the trend seems to be up. We actually took all of these lows and then found buyers, but we're not through either point. It's waiting for CPI, and I expect that to be the definitive factor. Remember, react and having patience, not prediction, is best here. If you do this, and then you come back down, and then you make a lower, kind of like that switch there, then you're probably going to look for shorts. If you instantly go low and do that, then you're certainly going to look for longs. It's actually the reaction to the news and the initial push towards liquidity that I usually look for. It's so much better. It's hard to predict, of course, but I'm not predicting. I'm looking for the market to tell us what is going on. That's what you're looking for as well. It's what we're all looking for. Tell me what's happening so I can go and say, haha, everyone else got trapped. Let's follow the big money flows in the algorithm. That's part of what we do. And there's a course down below that I actually made called the Advanced Scalping Masterclass, soon to be renamed Advanced Scalping and Day Trading, because it's basically the same thing. And what it's based on is realistically understanding money flow a lot better and understanding where are the big players positioning and why you need to be more patient to react to these, set alerts, set levels, all those types of things. Let's move over to Tesla. This is a great example of two ways you can look at this. We gapped above and we held the level. Now, some people would say, well, that looks like an island reversal. We've got inflation coming. If we end up seeing a sell during the session, we could see sustained selling because all of a sudden it'd be gap up, gap down. That's an island reversal. So I think this is the first of the tech stocks that we'll look at that are floating this way. But yeah, that's one option. The other thing you could say is, well, look, it gapped down, it gapped up. So pullbacks should be met by buy demand. I think I'd draw a fib here, get a 61.8. And if it came down initially, it depends whether it gaps on the open. So at this stage, I think that could be an island reversal towards the short. And it's really going to come down to the other markets to show us the way. Let's take a look at Amazon. You can see a very similar thing. Gaps up, holds the level for a few sessions. Do we gap down? And then all of a sudden it's a turn point. Let me just show you here. I'm going to draw this fib, and I haven't done this on Amazon, but you'll notice that we're back to that level and then we've created this zone. So pretty critical point here for Amazon. It's not just Amazon. My favorite, Microsoft, at the highs. Look at this, the resistance or supply highs. Notice what happened before. Can you see why, some of these big stocks are starting to say, well, maybe there's something a little bit dodgy here into earnings, because they're all at these critical highs, which makes sense. I mean, they're going to be sitting around these zones ahead of inflation, ahead of the bank's reports and all of those things. Same thing with semiconductors. They actually went a little bit earlier. We got a gap up, gap down. We're back at that level. So again, if inflation doesn't come in favorably here, it's going to be a big deal. If you put in stocks, which a lot of people like as well, very similar. And you can again see kind of where you're sitting. So I'd like to see how the daily closes, but we'll report here on the channel. Make sure you subscribe. We'll be all over it. Utilities, just wanted to point out, still doing well. It's still doing okay. It's grinding its way up. Not long left on this one. In fact, it's pretty much hitting my timing for it. So yeah, very, very cautious here at these highs, but it hit the target that I wanted, which was 70. The next target would be 72. And we're kind of like cautiously optimistic there. Let's move over to RSP. RSP is the equal weighted ETF. It gives us a bit more of an idea than the S&P 500 itself of what's going on underneath the hood. It's at resistance at the 61.8 at the critical level, daily close above, probably moving to 150. So again, that's going to push that narrative of us seeing the markets rallying through and going to the next key equilibrium zones. The DAX, literally a doji on the highs. There it is, the doji. It has no idea what it wants to do. It's waiting for the numbers. Let's move over to the XJO. Sorry, I forgot to put the watermark on it. That's the Australian market here. And you can see again at the highs, just right on that level. I thought 7,200 might be a short zone for this. Obviously, it didn't happen. It's gone to the next level, but it's at this super critical level. We breached through, and all of a sudden, you start talking about, okay, well, that lets us through to 75.50. That's what's at stake here in the next couple of days. Some serious levels that we're looking at. US 2000 had a pretty good session on it, recovered a bit. It's in the middle of nowhere, this one. This looks bullish, but we don't even know yet. It pulled back the correct way. I really usually like that type of wick to show me further buys coming through. If I was looking at this chart on the merits, I would say it looks okay, actually. But yeah, again, inflation's going to put it all out of whack, because when it took this low, and especially this, it does look like accumulation. I'd like to see more volume coming through it. Let's have a look at IWM, which is the main ETF people trade. So you can see that volume drop off. I would have liked to have seen that remain consistent. Wyckoff's third law of effort. But yeah, you can like what you see here on Russell. I think Russell presents an interesting picture. It's a very interesting picture. We'll have to come back to that one. Qs, they're all at highs. Watch reaction here. My red zone, I like that zone very much. Obviously, we know where the buyers have sat, which is sitting under this 313. Closure below there should get us the gap fill at 306. Lots at stake, nothing new. US 100, same thing. Found a little bit of weakness, middle of nowhere. Watching reaction, of course, at the highs. Looking for closes underneath 12,875 to get us back down. Let's move over to the big one, though, S&P 500. So we know where the weekly options lows and highs are. I've updated those at the start of the week. But what we're doing is we're really cautious around here. Notice this little doji candle. It's unsure of its next move, and that's kind of important when we face the facts of what's about to occur. Here is the downward trend line on the stock market. We know, again, we're at that critical resistance. Now, notice here we have what I call a technical gap and unfilled gap. We could actually see the report come out. The markets go bullish initially, push this narrative, and then turn down. Now, if that happened and we got underneath this low, ooh, get ready, bears. You'd be very excited about that. So if it went bull, bear bust, got underneath, pulled back, you'd be pretty much on the short side. At least the statistics would present that way in terms of what we're looking at here from the technical basis. Let's look at the US 500. Yeah, there's bullish and bearish cases to be made, why it makes it tough. We sat at this level. That was paint drying. I'm glad I didn't sit around for that session, or I wasn't awake anyway. I was in a deep slumber after the birth of my son, but or trying to anyway. But yeah, this particular area here, look at this little doji. I mean, it was the most boring day ever ahead of inflation, which probably is to be expected. Bullish hammer will make people think it's bullish. I understand that. It's all about the reaction. Initial takedown, then rally through to a new high. I kind of feel like we're going towards that 4,300, 4,350 at that point, and we'll just see grinding up. We'll kind of do something like this and then go through. Now, from the bear side, you're looking at ideally it would actually take this high and maybe even this high here and then rally back through. Now, I know that sounds annoying, but if you get kind of within a 0.2 tolerance anyway, we often have seen the first move become false and then it moves through. If we get like a 0.5 reading different on inflation, then all of a sudden it's just going to go ballistic in one direction. I think that's important to state when we're looking at charts like this. We're at critical. It's absolutely boring. Once I refresh this, you'll see what I mean. And it's exactly where it was as of the previous video. So yeah, that's what we find ourselves at. Let's refresh the options moving forward. We'll just do that together right now. Let's bring up the 14th. So you can see 420, 412s, interesting levels, calls there, a lot of puts sitting now at 405, 400, and 390. This is not a big week for options expiration, so we're going to ignore it a lot more. But I think it's important to state that we've actually got more calls, and the max pain's actually at 405, which is still 4 to 5 points below on the SPY where we are right now. So it's kind of saying, well, there's more risk to the upside. If you're going to buy the upside, maybe there's more risk there than actually the downside based on options alone. I'm not going to pay too much attention to that. Bitcoin rejects our level for now. So 30,200 was a level I really wanted to see the market go to. We've now hit 30,560. And if we scroll into like a 15-minute chart and look at the structure so far, you'll see that the market has made a higher high. The market has come down to this level of demand, and I probably would be paying attention to that as well. If it does something like this during inflation, then it's probably going to drive higher. If it comes like up initially and then drives lower and then busts that level, I would think that pullbacks get met by some sell demand. Of course, levels such as 29.7, 29.177, they're going to be little demand levels, but don't ignore this. And I feel like it's building to maybe take losses, then buy up, or the opposite. The news is important. React to the news. Don't necessarily predict it. Predicting inflation, who knows? Total guess. However, you might think you know. Put it down in the comments down below, actually. Let's see what everyone thinks. But yeah, I usually like to stick to it that way. So we know, and we've talked about inflation so many times now, core CPI and the CPI year. 5.1 expected, 6% last time, so pretty decent drop. It's expected to remain at 0.4%. So will we have, also look at the report, is it sticky? Is it in shelter still? Is it in food? Where is this inflation coming through? That's going to be important. Then we move into the FOMC meeting minutes, which I don't know if it'll tell us that much more, but it'll certainly be there. And then we go through the week. We've got core PPI. That's another bit of information. Retail sales. That'll be an interesting one again because it's starting to turn bad. And prelim UOM consumer sentiment along with the bank's numbers. It's all happening. It's a super exciting time. I always get excited about these times in the markets because it's so interesting just following along, seeing how things move, and really starting to understand the world a little bit differently. It is a lot of tracking. It's a lot of psychology game and warfare, and that's kind of the way that markets play. So hopefully we've given you some value today. If you enjoyed it, subscribe, smash that like button, and remember to come and follow us on the other socials. That really helps me out. And of course, helps this channel grow, and the community, which is the best on YouTube by far. You guys absolutely smash it and rock. I'm telling you, I've watched a lot of communities over the years, and you guys are just, everyone's level-headed, really gets into both sides. I'm super proud of everyone. I think it's awesome. So yeah, if you're interested, do it. 3 free trading cheat sheets as well. You can click and submit to that. But thanks so much for watching. I think it's awesome, and let's get into some exciting weeks ahead during earnings season.